Recipes for technical trading success in Cook's Kitchen.
When you get the best of it, make the most of it. That's a quote by a famous gambling professor, Mason Malmuth, and he talks a lot about poker, writes a lot about poker. Today's lesson is about the relationship between poker and investing in the stock market. I'm not a poker expert, but I am pretty good at playing poker in the stock market. Let me share with you some commentary I gave my Taser Trader group last night on this theme. I wrote to them last night, know the game, play the player. And let me just read a few excerpts here that I talked to them about that quote, when you get the best of it, make the most of it. If you're familiar with probability and statistics applications of poker to investing, you already know what Malmuth is talking about. The randomness and viciousness of poker demands that you ruthlessly apply optimally rational, probability-based thinking to your decisions, in addition to deep and active psychoanalysis of your opponents. Some players are masters of poker hand probability analysis and want very little opponent interaction, reading, or social gamesmanship. These are the players who wear sunglasses and try to avoid most interaction at the table. Then there are the true behavioral scientists like Daniel Negreanu. Now, if you watch poker at all, you know who Negreanu is, and he's just a treat to watch. What does he do in games? He constantly dialogues with the other players to figure out what they have in their hand, you know, especially when the pots are rich and somebody's raising, somebody's calling, somebody's going all in. You know, he already knows the probability of the hands, but he wants to figure out what does that other player have, you know. Let's say there's an ace on the board. He tries to figure out if they're holding an ace. So he's running through his own mental gymnastics, but he's gaming them and trying to get a reaction out of them, especially the ones that don't like to show a reaction. He tries to say things, throw things out there, jokes, maybe even a friendly taunt, and see if he can catch a twitch, you know, whatever it is. They make a movement that signals, yeah, he's got him. You know, that guy's holding ace jack with you know, with an ace in the flop. So that's the kind of thing that Daniel Negreanu does. Back to my lesson here. Negreanu is so secure with his probability-weighted strategies for any given hand that he can spend the majority of his time and attention at the table analyzing, dissecting, and gaming player behavior and interactions, where the real difference and edge is found in games with high randomness. What I mean there is, you know, where the real edge is found. Because in something like poker, which has discrete finite probability, you know, and you see that when the announcers know everyone's hands and they're calculating the probabilities, you know, that's finite or discrete. Your edge is not your mastery of probability, and you certainly can't master randomness, what cards you got dealt. So the big edge and the difference that you know, that makes the difference between a champion and somebody who doesn't get to come back to the tables is somebody who can read human behavior and figure out what the other guy has. So obviously, if you want to learn how to play poker better, I summed up for my traders last night. I said, so what does this have to do with us? Number one, know your probability scenarios, obviously. Number two, play your opponents for both their strengths and their weaknesses. And so this has a lot to do with knowing risk reward. What I go into next is to really apply this to the stock market now, I want to talk about the bears that are out there. Some big name hedge fund managers like Ray Dalio of Bridgewater, Howard Marks of Oaktree, I named them in my article. They're very cautious on the market. And so yet the market continues to make new highs. And if you listen to them, even for the past 2 years, you might have sold the majority of your stocks, which I think is crazy. So we've been here before where you get very smart people, say a Jeff Gundlach or Albert Edwards from SocGen, talking about all the global macro conditions that make the market unsafe at these levels. And it's unsustainable. But if you listen to them, then you don't make money, and the market keeps driving higher. So we've been here before, and I continue to buy stocks and think the market's going higher. So then I talk about the other successful players at the table. You can see here, I'll highlight this part here. other successful players at the table like David Tepper of Appaloosa, Dan Loeb of Third Point, Lee Ainsley of Maverick Capital, and Andreas Halverson of Viking Global, they're not wringing their hands about global macro worries. They are still heads down picking stocks for the long run of 2 to 5 years, like in Alibaba. So heads down picking stocks has been one of my favorite phrases that I've been talking about for at least 3 or 4 years. And that's the difference, is some of these hedge fund managers are not worried about global macro. They're still picking stocks. So, and I mentioned a few of them here, and I mentioned Alibaba because several of them bought Alibaba. Now, and I'm going to show you what they did. Before I do, let me just give you a heads up why I still own Alibaba. You have to keep up with their news. I mean, bookmark their investor relations homepage and see what's going on, because they're doing something exciting just about every other day. I'll look at one press release yesterday. Alibaba to take majority stake in Sinow, I believe I'm pronouncing that right, Sinow Network, which is a global shipping logistics network. So, I mean, Alibaba, I'm talking to people, somebody who works here at Zacks, does car repair, and he uses Alipay because he can get any part from anywhere in the world and, you know, at a great price, and the shipping doesn't hurt. So, you know, Alibaba is the global player here, and buying this logistics company, Sinow, is only, you know, they have a plan to invest $15 billion in their global logistics network. Another story that is not a press release for Baba, and I'm not sure why, but I came across it yesterday, or actually today, in the IoT newsletter, is that Alibaba unveils its Internet of Things operating system called AliOS. So, you know, just another example of how they continue to innovate, and, you know, they've got, I mean, they probably only have 3 to 4 business segments, you know, as they truly define them for operating revenue, but they probably have 25 to 30 different businesses, and some of them are significant, you know, so everything from the e-commerce to payments to technology, the cloud, you know, they are truly the Amazon of China in terms of their destiny and their potential, the way they're expanding. And they've got this huge growth opportunity because they're commanding all these businesses, and they're doing it in this enormous market, China, where they get to capture the majority share in so many of these businesses. So pay attention to what Alibaba's doing. Now let's look at who bought Alibaba. I said, you know, here are the hedge fund managers who are not wringing their hands about global macro. They're heads down picking stocks. And it's a list of some of my who's who favorites among hedge funds. So I'm using the site Whale Wisdom right now. If you see my screen, Whale Wisdom has a great database. You can get a lot of free information. It's challenging to sort through. If you're not a subscriber, you kind of have to figure out what you're doing. What I'm going to do here is I'm going to sort by the change in shares, and then I'll check against the date when this is reported. If anything that was reported in mid-August here for 2017 would have been the 13F for a Q2 filing. So, and I ranked the shares in terms of largest accumulation. HSBC Holdings took, you know, bought, basically increased their position by 50%, going from about 20 million to about 30 million. There's a lot of option positions in here. Obviously, Fidelity, T. Rowe Price are in here. I want to look at the managers I mentioned. Okay, so here's Third Point right here. This is Dan Loeb, Third Point, and new position, 4.5 million shares. Yep, 811, so that was his 13F. Okay, next up, Appaloosa. That's David Tepper. Brand new position, 3.69 million shares, 814, August 14th. Yep, so that was his 13F for Q2. Who else is on here? Janus Henderson. I don't know if you know this, but Janus, the fund management firm, merged with a large British fund management firm sometime, I think, in Q1 or Q2, called Henderson. So now the firm is called Janus Henderson. Obviously, legendary growth investors there. What are they doing? They are adding to their BABA position, 2.3 million shares to bring it to 4.4. All right, who else is on here? Lone Pine. This is Steve Mandel, guy I've followed many times. Smart guy. He's not worried about global macro. He now has 11.66 million shares of Alibaba as of his latest filing. In August, he added 1.77. Just continues to love the story. And let me just look at a couple more here. Fred Alger, I think, is a pretty infamous small cap manager, but definitely a growth stock manager, and added 1.2 million shares to bring his to over 3 million. Of the whales I mentioned before, the only one I don't have is that I'm showing you is Viking Global, and they did add 1 million shares to their position. So, that's what these firms are doing. They're investing for the long term in Alibaba because they recognize the story when so many didn't, when so many would have turned you away. And we've owned it since $100 for Taser Trader, and my target has been $200. It's in my $200 club. And I just read a report yesterday. Wells Fargo resumed coverage of Alibaba, detailing a lot of the things that I just talked about, and set their outperform price target at 225. So if you can get in Alibaba, anywhere between 160 and 175, that's my recommendation to do so for the long term. For long-term investors. Now, speaking of, we're going to come back to the $200 club, but let me show you a fund manager who is not bearish, but throwing up his hands and basically saying, I don't get this market, I'm done, and he just closed his fund. Hugh Hendry, a small manager. Here was the story as Zero Hedge titled it September 15th. Markets are wrong. Hugh Hendry shuts down his hedge fund. Here is his farewell letter. So you can Google that, find that on Zero Hedge, and read the farewell letter. This was how I finished my report last night to Taser traders. Talking about keeping things in perspective. Let me just read here again. In all their macro analysis, the bears, they missed the simplest of factors. Technological innovation plus investment liquidity, meaning money that's 60. By the way, when I say investment liquidity, how much are we talking about? CME Group estimates that there is 66 trillion worldwide linked directly to equity investments. I mean, that's just a mind-boggling number. Yeah, the U.S. market is worth over 20 trillion, but yeah, then start adding up, Europe, China, and you get this incredible amount of money, all earmarked for equities. Is it running away from the market? No, it's not. So that's the number to keep in mind, 66 trillion when you think of investment liquidity. Plus stable economic growth and liquidity, meaning favorable interest rates from the Fed. This equals equities as the premier growth investment over many years of a long cycle. So I say overcomplicating this equation only leads to missing great rallies. And I've seen this movie before, so then I closed out. I said I wanted my people to read this article, and this was on Value Walk. Value Walk titled their article, Hugh Hendry closes shop amid, quote, almost impossible environment for small funds. And he talks about how wrong the market is. Well, if you're an investor and you say that the market is rigged, the market is wrong, I mean, you better be doing your math right. And in this case, Hugh Hendry's funds had struggled. I believe maybe I don't even know if he had 100 million under management, but maybe he slipped below that and just decided to close the fund and call it quits. And so this is the behavioral analysis that you do. Like, if you want to play the stock market the way Daniel Negreanu plays poker, you have to do this kind of behavioral finance analysis and know who the players are and know what they're doing. I follow the guys who are heads down picking stocks, and it's paid off. Now, so let's revisit the $200 club and see what's going on, because I actually had a blunder this week. You won't believe this, but I sold a member of the $200 club, and I greatly regret it. So let's take a look and feel my pain here. Oh, I went to the wrong place. I was going to go to, I want to show you a stock chart. The stock is Lam Research, LRCX. You know it, you love it, and Kevin was an idiot for selling it. So here we are. Whoa, Bloomberg, out of here. Oh boy. Okay, got rid of that guy. Okay, so here I am. You know why I sold Lam Research? Because on Monday, when North Korea said they believe that the U.S. has declared war on them, I thought, okay, now this is going to heat up. And a few of my chip stocks were down, Lam Research, Applied Materials, and I thought, you know what, they could really hit this. And the semiconductors do have some significant exposure to, obviously, to Asia, but even the Korean Peninsula, Samsung in South Korea. So I thought, you know what, I've got profits in Lam. Let me just take them now and see what happens with this. Because I thought it was a different tone when North Korea says that they believe the U.S. has declared war on them, and now they can shoot down our bombers if we fly them too close again. But it was the wrong move, because take a look at my price chart here. Obviously, the market still does not care. Lam Research is up over $10 today. Look at that beautiful candle. What a thing of beauty. Closing at new highs today, unreal. So kicking myself there. Yeah, I will live to regret that one. All right, let's check in with other members of the $200 club. Stocks going to $200. Some are getting, this one's been the leader right here. Align Technologies. They make the Invisalign clear aligners, the alternative to braces. Just a beautiful chart, beautiful company. We've owned it since 133 for Healthcare Innovators. And just consolidating here, getting ready to probably be the first one to make it to 200. Let's take a look at Facebook. Facebook is look what Facebook did the other day. Boy, I thought, man, we might get another chance to buy it at 160. I forgot what the bearish report was on Facebook. Oh, maybe it was when they had to turn in, they turned over all that ad data for, fake news Russian election ads, and maybe there was a bad report surrounding that. But it's coming back. I'd still be a buyer of Facebook in the 160s. And last but not least, let's see how Bob is doing, see if you got a chance to get in here. Yeah, look at that. You can still buy BABA under 175. And if it comes down and touches the 50-day at 165, you want to be a buyer, and definitely down to 160. And I've sort of added a fifth member to the $200 club, and that's NVIDIA. And as a matter of fact, I bought some today because my logic here with NVIDIA is, you have to own it for what they're doing, just dominating in AI, autonomous cars, cryptocurrencies, big data mining, supercomputers, the company, and just, they're trying to branch out and be in all these areas where you need like intelligent computing. And the other big thing is that they are committed to building the developer base. They announced in May that they were going to train 100,000 developers on their platform. And you know what that means? It means that you're going to have all these skilled people out there who only want to develop on NVIDIA platforms for AI or machine learning or these advanced technologies. So I said, you know what? Buy NVIDIA here today under 175. And if it dips to 160, you buy more. I'm just not going to wait for it anymore. All right, last thing I want to talk about, while we're picking stocks, keeping our heads down, not worrying about the global macro, like I did with North Korea, cybersecurity and cyber espionage. I did, if you have a chance, check out this week's top stock pick video I did with Shiraz on Monday. My pick was FireEye. I own it. Continue to accumulate it, between 15 and 17. And I even give an options, good options play in that video. But here's the main message: is that, and you don't have to pick FireEye, but I'm saying look at all of these security companies, because what is happening since Equifax is that the corporate budgets will increase. So if a $100 billion company had a $500 million budget for cybersecurity for their firm, they're probably going to double or triple that now. So you're just going to see billions more come in and be buying this stuff, because if you're on a board, your CEO, you cannot afford to have happen what happened to Equifax. You will buy a solution now and maybe buy a new one next week. And the lesson with Equifax was that the hackers were in there for weeks undetected. So, you know, it's about surveillance, detection, you know, guarding the perimeter, and then having a response. And that's what FireEye says they specialize in, and that's what the analysts say too with their new Helix platform, is not just, you know, surveillance, but detection and response. So, I mean, watch the space closely, because the budgets are going to increase, so you see money pour in there. All right. That's the last thing I want to talk about. So play poker with the market, know who the players are, play the players, and in this environment where the economy is sound, global growth is just humming along, money is still cheap, you've got the liquidity, growth investors are still heads down picking stocks, and that you should be too. Thanks for joining me.